So today I wanted to take some time and I wanted to talk about a question that comes up a lot. It's something that I struggle with, and it's something that I find a lot of people asking within the Creating Generational Freedom program. In general, I'm seeing investors across the country ask this question. And the reason I picked this topic for this week was because last week I was running numbers with a member of Creating Generational Freedom who was actually in escrow for a short-term rental in Florida. It was worth around $800,000, and there was a little bit of back and forth going on. He was doing due diligence. We were running numbers, stress testing them, fine-tuning things, and this always happens, especially when you're at the stage where you actually are getting a property and you have to make those final decisions, make sure you lock it in. The question always comes up, the worst case scenario always starts playing in your mind, right? So naturally, he was asking questions about what if the market crashes? I'm getting this short-term rental, it's pretty expensive. I have a strategy, but what if the market crashes? Am I still going to be okay? And that's the question I want to address in this week. So I want to start off with some fundamentals, right? I don't believe in predictions. No one has a crystal ball. We don't know what's going to happen with the real estate market. And when I say market, I mean real estate market, guys. But we are going to talk about fundamentals, and I'm going to run two different scenarios for two different kinds of properties just to see what would happen if there was a market correction. And we'll bring it back to the fundamentals, and we'll bring it back to strategy, because in my opinion, I don't believe in timing the market. I believe in having a strategy that you can use in any market, that is able to weather any market, right? So let's start off talking a little bit about fundamentals. And this is not a prediction. The important thing to remember, and with prices going up so high, it's very easy for most of us to go back to the '08 market crash and try to make comparisons. The important thing to remember is that in 2008, when there was the housing market crash, the big part of it was because of subprime lending and overbuilding, both of which we don't have in the current market, right? So that's a really important thing to remember. In the current market, the reason home prices have gone up significantly is because of demand-supply mismatch, right? We're just not seeing the inventory in the market, and that's driving home prices up. We are in a hyperinflationary market that's also driving up the cost of real assets. And all of us know that, especially because of COVID, suddenly we had supply chain delays, building material shortages. All of that increases the price of new builds, which then also raises the prices of existing homes, right? All of that led to this run up where we've seen high double-digit home price increases in multiple markets around the country for the last 2 years, right? But it's also important to remember where we are now. We are now at a point where interest rates are rising. And although historically, we still have a low interest rate environment. It's hard to believe. I believe it was in the 1980s, interest rates in this country were up to 18%, right? So we still do have historically low interest rates, but interest rates are rising, and that is putting downward pressure on the housing market. That's important to remember. And we've seen this huge rise in rent growth and home prices. That's unprecedented, and it's almost not tenable, right? So something has to give, and it's not, it's perfectly all right to say that right now we're in a position where market conditions are questionable. We don't know what's next. Most of us don't know, and which is why it's easy to make predictions. And although I don't time the market, I still do think it's important to look at these different scenarios and run them in your head so you're making the right decisions, right? That being said, seasoned investors and even new investors, we have investors within the Creating Generational Freedom program who've in the last month purchased $7 million worth of real estate. And these are all deals where the numbers make sense, right? So investors are still buying. And I think if I want to bring it back to the fundamentals of investing in real estate, which is that your returns from real estate are always going to be fourfold, right? And I always say this. When prices go up and down, it does affect your return from property appreciation, and that is important. But it's important to remember that that's just one part of the entire picture, right? You have cash flow, which is a big part of your returns as a real estate investor, right? Most of us are looking for deals that are cash flowing. So we're going to look to see what happens to that when home prices, when we're on multiple different scenarios, right? So even if prices go down, you have cash flow from real estate. That's one way you're getting returns. You have debt pay down, which is another significant way of generating returns in real estate. And that is when your tenants are paying down your mortgage, right? You're taking the rent to pay down your mortgage, and the principal portion of the mortgage is actually going towards your equity in that property, right? So debt pay down is another way where you're getting returns. And just to give you an average number, cash flow in the current market, we're still seeing anywhere from 4 to 7% cash on cash returns, so annualized returns from cash flow in strong markets with a basic buy and hold borrowing strategy. We're still seeing that in strong markets. Debt pay down, typically for a long-term buy and hold where you're not doing anything fancy, is going to be around 6% annualized, right? And then you also have your returns from tax savings. And a lot of the members in our community are tapping into those tax savings and multiple ways to do it. You could do it with short-term rentals. You could do it if you or your spouse can qualify as a real estate professional. So all of those things need to be factored in also. And we'll run different numbers to see how that plays out in the long run. Okay, before I actually go into the scenarios, I want to quickly go over what I think should be a key part of anyone's strategy when you're acquiring real estate, especially in this market, to make sure that you're able to weather any market condition. And so a few things to remember, which I think are key, especially for this market, is that especially in the current market, you want to have a long-term strategy. This is likely not the market where you want to be flipping properties, especially if you're concerned about a market crash, right? So when you have a long-term strategy, then you're able to weather, a market correction. So that's important to remember. It's still possible to find good deals in this market. And when I say good deals, I'm talking about cash flowing properties, right? So you don't want to have a property that you're pumping money into. You want to have a property that is generating returns every month, right? We have members within our community who are acquiring short-term rentals, long-term rentals, just buy and hold turnkey properties, small, mid-size, and large multifamily properties, all of whom are able to find good deals where the numbers make sense. And then I always talk about, well, if the numbers don't make sense, see how you can boost returns. And there are so many ways to boost returns. The simplest of which are going to be when you value add, where you do a rehab on the property and you're increasing the property price rapidly, you're increasing the rents you can command, or when you're using these tax strategies that I talk about all the time, right? We're going to talk about that in detail in a little bit, but you want to make sure you have a property that is cash flowing, that is putting money in your pocket, right? That is at least cash flow neutral so that you're not putting money into the property. And that's going to be important to be able to weather any market corrections. The next thing is you want to be able to, you want to conservatively underwrite any deal, right? So you want to know to run your numbers accurately, and you should be able to stress test each of your deals and run numbers for different scenarios to make sure that this property is going to do okay. If you see a drop in occupancy, if you see a drop in average daily rates for short-term rentals, if you see a drop in rents. And this is where it's important to have a calculator. I know that for the first 5 years that I was investing in real estate, I was almost winging it. I don't think I was factoring in vacancy or capital expenditures or maintenance in the equation. And so if you're looking for reliable calculators to use, I always direct everyone to Generational Wealth MD's resources section, where you can find free calculators for short-term rentals and long-term rentals. So always make sure you're running your numbers and you're stress testing your deal. And while we're talking about stress testing numbers, I want to highlight what happened during the last market correction, right? Yes, in some markets, home prices dropped 30%. And yes, we are not in the same environment today. But the important thing to remember is that even in that market, right, even with everything that was wrong about that market. Rents, national rents across the country, right, dropped 4%, I believe, in '08, dropped another 5% in '09, or like a total of 9% before bouncing right back up. Okay, and that's the important thing to remember when you're trying to stress test your deals and run numbers for different scenarios. Okay, so stress testing your deals and knowing how to run your numbers is super important. The other important thing for that's a component of a strategy that is really going to help you in this market is having adequate cash reserves, right? And this is especially true if you have an older property where you may need to put more money in at some point. You want to be able to do that effectively, and you want to have cash reserves for it. But also for short-term rentals, whenever you're running numbers, I always say anyone investing in a short-term rental has to factor in seasonality, and therefore you need to have adequate reserves to be able to get you through. Okay, so that's important. And then really important to be responsibly leveraged. I can't talk about this enough. What do I mean by being responsibly leveraged? If you can get 30-year fixed long-term debt, then you're taking out a lot of assumptions out of the equation, which means that even if there is a market correction, you are able to weather it because you've already run numbers and you have fixed debt, right? Your debt isn't changing. So that's important. That's also a great way to hedge against inflation. So again, if you can get those loan products, great. But if you are getting commercial loan products, then it's really important to stress test your deal and make sure you have adequate equity in the property. That's where you don't want to be over leveraged, especially if you think we're in a scenario where we could be seeing market corrections, right? So be responsibly leveraged. And then finally, strong market fundamentals. You have to pick markets that are that have strong metrics. So you're looking at industry diversification, job growth, population growth, income growth, right? Median household income growth, and those markets typically have strong rent growth. So all of this is going to really help you, pick a strategy that is going to be resilient. Okay, enough about strategy. I'm going to repeat all of this again if you weren't able to catch any of it. But let's talk numbers. Let's run some scenarios, right? So let's see what happens if you have a long-term turnkey buy and hold property right now. So we're not doing anything fancy with this first example. We're just taking a boring buy and hold and seeing how that performs if you were to purchase now versus if you were to wait and purchase it later if we end up seeing a market crash, right? So this is almost like running a pro forma where we're going to take the scenario and see how it plays out over 10 years. Again, I say long-term strategy is always the best, especially in this market. So when I'm doing my assumptions, just to give you an idea, and if you want to run different assumptions, feel free to go ahead and use the calculators and run your own assumptions. But typically, it's normal to use 3% annual rent and home price growth when you're trying to build those numbers forward, and 2% expense growth. Those are very typical. That's what most underwriting uses when they're building out pro formas, even in the large multifamily space. Now, if you want to do 3% expense growth, that's perfectly fine, but those are the numbers that I used for these scenarios, okay? So we're going to talk about a scenario. So let's say the question is, do I buy a home now if the home is worth $400,000? And I actually ran these numbers for a property in Bakersfield, which is my market. And let's say interest rates are 5% at this point, right? For someone who's trying to purchase that investment property. And the question is, do I buy it now at 400,000 with a 5% interest rate, or do I wait and, I expect, and this is worst case scenario, right? For the current market, a 10% correction is probably worst case scenario, in my opinion. I expect maybe a flattening or a smaller drop, but 10% is almost like my worst case scenario for this market. So the question is going to be buy now at 400,000 with 5% interest rate versus buying it when I anticipate a crash. I'm not saying I anticipate this. I'm talking worst case scenario, trying to run some numbers here, okay? Where home prices drop by 10%, but interest rates at that point have risen to 5.75%, right? So $360,000 property at 5.75 interest rate at a later point versus buying it now. So let's see what those numbers play out to be. So I actually plugged this into our calculator and I ran the numbers to see what it would look like with with property taxes and insurance, using the same property tax rate, right, that it would be. And so your property taxes actually drop if you purchase the property at a lower price. So all of that's been factored in. And I came up with these numbers. So cash flow in the first scenario, if you buy a $400,000 property at a 5% interest rate, cash flow ends up being around $530 a month, right? And we're still seeing positive cash flow with turnkey properties, long-term rentals in my market with a 6% cash and cash return, right? And the mortgage ends up being around $1,600. Okay, that's the scenario. Now, if you were to purchase the same property at after a 10% drop in price at $360,000 with a 5.75% interest rate, the cash flow now is slightly higher. It ends up being $600, so it's up by $70 a month. Not much. That's the important point to remember. Not much, and your cash and cash return bumps up to 7%. But your mortgage in that scenario ends up being $1,570. So it's only a difference of $30. So it's $30 less than the prior scenario. So the point being that is that, even if you see that significant price drop, we know that interest rates are going up. That is almost, that's something most of us can agree on. In that scenario with those rising interest rates, the effect on cash flow isn't significant, right? It isn't significant. And now we're comparing current scenario to like a possible worst case scenario, right? So we're seeing that. And then what would happen to home prices? Like over 10 years, what would happen to this property, right? So if you look at over 10 years, that $400,000 property, if we were to put in a 3% annual rent growth, now you have to remember that national historic rent increase, not rent growth, I'm sorry, property price growth historically has been close to 4%, but we're using a conservative 3% number, right? So if you're taking the $400,000 property and you're putting a 3% annual home price increase into the equation, then at the end of 10 years, that property is likely worth $520,000, right? And that property, and if you apply the same 3% rent increase and 2% expense increase to the equation, what you have to remember with rental properties is that your mortgage stays fixed. So although your expenses are increasing at 2% and rent is increasing at 3%, that gap keeps increasing because your largest expense, which is your mortgage, that stays pretty standard. Right. So over time, at the end of 10 years, with those projections, that property is going to have a cash flow which bumps up from $530 a month to $1,250 a month, right? And then over time, again, you've been having debt pay down, which is another way that your equity in that property is increasing. And that happens at an average rate of 6% annually. Now, what happens to the other property that you purchased at $360,000? Now, that property, if you apply the 3% home price increase annually, at the end of 10 years, that property is going to be close to $468,000, as opposed to the prior example where we probably at $520,000, right? And so, and then what about cash flow? Cash flow is going to be, again, with the same increase in expenses and same increase in rent over 10 years, the cash flow for that second scenario, the second property that you purchased at a lower rate but a higher interest rate, is going to have the same fixed debt, but cash flow is going to be $1,330 as opposed to $1,250 in the first example. So again, not that much of a difference. So cash flow is not that different. Now, you're listening to me and you're like, Param, what if there was a correction? Then that first property probably is also not at $520,000, right? It's probably going to see some correction. And so that's where the assumptions come in, right? So if you purchase a property now and you see some sort of correction, then that property is likely at the end of 10 years going to be close to that $468,000. And so that's where the whole question comes in. Do I wait? I may not increase my cash flow, but am I losing equity in the property because the property value drops? And the truth is that you're not, because in both scenarios, property prices are rising. And you put $10,000 less in down payment in the second scenario when you purchase the home at a lower price, but you're paying $10,000 more in interest over 10 years. So if you factor everything in, there isn't that much of a difference, right? Your cash flow is basically the same, not that much of a difference because interest rates rise if you are actually waiting to purchase the home at a discount. Your debt pay down is pretty similar in both scenarios. And in terms of home prices, if you have a long-term strategy, that property is likely going to increase in value. And then the question is, how much is it going to increase in value? And for you to even make this strategy work, the point is that you need to be right two times. You need to know when to exit, and you also need to know when to enter. And that's where most people get timing the market wrong. And this is true for the stock market, this is true for the real estate market. So for you to actually come out positive in this deal and to actually, have significantly more equity in the property at the end of the day because of catching that property price rise and not having a property price drop a little bit, you almost need to time the market right twice. But while you're holding out, you're also losing out on that 6% cash and cash return that you'd be getting. You're losing out on that 6% debt pay down. And what happens if you don't see that 10% drop in home prices? What happens if home prices just plateau or they go down by 5%, right? While interest rates are rising, then you're in a scenario where your cash flow may actually decrease, right? Because now your mortgage payment is actually higher because your interest rate is higher, and you may not be seeing any upside to having waited. So that's what you're weighing over here, right? Your cash flow doesn't significantly increase if you wait out because interest rates are rising. Your debt pay down is pretty similar, and now your interest rates are definitely rising. You're trying to time the market in terms of finding the right price, and you kind of need to be right two times. And if what you anticipate doesn't happen, then you've actually lost out in the game. So that's what I'm trying to get at. But that is our boring long-term rental buy and hold scenario. Now I want to go to the scenario that I was actually running with this member, right? The short-term rental, the 800,000 short-term rental in Orlando, Florida. So let's look at those numbers. And over there, and this is where I say when you're actually boosting returns, and I think most of us should employ some of those strategies to boost returns, then you're actually going to come out ahead if you're actually investing right now. So let's look at what his exact scenario was. So he had a short-term rental that he was purchasing for $800,000, and hopefully most of you are doing this. You are able to get a 10% down second home loan, and we talked about this on a previous episode. But you're able to get that 10% down loan, and he's only putting $80,000 into that property. And so his question was, what happens if the market crashes? So now let's look at best case scenario, which is what we were running our numbers for originally, right? Best case scenario based on AirDNA data, that property was generating 30% cash on cash return annually, right? So if you took the cash flow from that property annually and expressed it as a percentage of his initial down payment, which is $80,000, he was getting 30% cash on cash return. He was also, now if you think about this, when you only have 10% down in a property, and you're paying the mortgage down, when you're heavily leveraged in a property, your debt pay down is actually significantly higher. And I actually ran these numbers on a mortgage calculator. Debt pay down annually for him, the portion of his mortgage that he's paying down that goes towards principal, towards his equity in the property, that itself is generating a 15% return for him from debt pay down because he has that 10% down loan product, okay? And the strategy is for him to self-manage that property. And end of the year, if he has met criteria for material participation, which he should be meeting, then he's able to conservatively go in, and because the property is worth $800,000, he's likely going to be able to shelter close to $200,000 of his clinical income from taxes because of bonus depreciation, and his post-tax dollars saved should be close to $80,000, right? And so essentially what he is doing with this strategy, which most of you should try to incorporate if it's possible, if it makes sense to your real estate investing strategy, is that he puts $80,000 in, but when tax time comes next year, he's hopefully, because of bonus depreciation, because of meeting criteria for material participation, he's able to pull that out. He actually gets that money back in post-tax dollars saved on his tax, in terms of his tax refund, right? So that's best case scenario for him. Now, and that's actually a pretty good best case scenario, right? Even in this market. Now, we wanted to run worst case scenario numbers, right? So we're running really worst case scenario numbers. So let's say 10 years from now, his property has not increased in price at all, right? It's just the same price, right? And let's say that every year he is just breaking even on the property. He is not cash flow positive at all. All his revenue just matches his expenses, right? So he's cash flow neutral in his property, right? He still has a property where if you realize he put 80,000 into the property this year, he's putting it in. Next year, he gets the 80,000 as a tax refund, right? So he has a property which is technically in that infinite return scenario, right? So he doesn't really have money in the property, but the property still has that equity, the $80,000 of equity in the property. And say 10 years from now, prices have fluctuated and it's back to the price that he purchased it at right now. He still has that $80,000 worth of equity in that property. Now, in addition to that, remember, because he has a 10% down loan, his annualized return from debt pay down is 15%, right? And that's specifically for that example. That's what I ran. I'm assuming it's going to be very similar for any price property just because of the 10% down loan product and how much you're paying back every year. If it's amortized over 30 years, you can run the numbers for your specific scenario. So he has a property with $80,000 with which he has no money in, right? All his money in the deal is out. It has $80,000 of equity in it, right? And it has 15 because let's just assume his equity hasn't increased because his home price hasn't increased at all. Worst case scenario, no cash flow, but he also has 15% annualized returns from debt pay down in that property. So think about it. 80,000 of equity just sitting there, right? In a property, he has no money left in that deal, and 15% annualized returns from debt pay down. Even that worst case scenario doesn't sound that bad. And so we decided to go ahead and pull the trigger on that property. And so it's very common for these questions to come up, especially when, it's almost more common for it to come up after you've locked the property in, because before that, all you're concerned about is locking that property in. It's when you have it in your hand and you're going through that due diligence period, that's when the questions always come up. So I'm hoping that listening to these scenarios is giving you a different perspective and helping you factor in different things that you should be looking at when you're looking at returns from real estate. Now, this scenario factored in tax savings from a short-term rental. The same thing could apply to you if you or your spouse qualifies as a real estate professional. The same thing could be applicable if you're boosting returns by using the BRRRR strategy, which is when you buy a property, you rehab the property, you increase value, you force appreciation, increase the equity in the property right away without waiting for market appreciation. And you're also increasing your revenue from the property because now you can command a higher rate for it or higher rent, right? So again, coming back to the basics, just so we can wrap it up, timing the market is hard because you have to be right twice as far as getting, figuring out what the peak is and figuring out your entry point. In an environment where interest rates are rising, when you're holding out, you're likely not going to see a huge spike in your cash flow, even if there is a 10% market correction like we saw in our scenarios. And you could potentially be losing out on tax dollars that you could be saving, which again, once you've paid that, you're not getting that back. So if that's part of your strategy, that could hugely boost your returns. And if you're holding out, you're also losing out on your returns from debt pay down, which can be significant in some examples like we saw. So factor all of these things in. If you're anticipating a crash and if the market just plateaus or there's like a 2-3% price drop, then you're not going to see the upside that you're expecting. So just make sure you're factoring all of this in before you make any decisions. And I want to bring it back to those fundamentals of safely investing in any market. Remember, have a long-term strategy. You can still find good cash flowing properties. See if you can bump up those returns by using value add or by using some of those tax strategies. Most of our members continue to buy cash flow positive properties. So those deals are out there. You can find them. Just make sure you're stress testing your deal. Make sure you're running numbers conservatively. Use the calculators. Again, generationalwealthmd.com. Go to the resources section. You can find those free calculators. Have adequate cash reserves, especially if you have short-term rentals. Be responsibly leveraged. If you have commercial loan products, make sure you have significant equity in the property. Make sure when you're underwriting it for multiple different scenarios where you can, you can survive even if you have drops in occupancy and a drop in rents. and always invest in markets with strong fundamentals. That is like, this is super important because every market performs differently in a correction. If you look at the last correction, so many markets bounced back pretty rapidly. Dallas, Texas didn't even see that much of a dip. And then there were markets which still haven't recovered. So market fundamentals, you cannot ignore that. And that's it. So make sure you use those resources. If any of you want to learn how to invest in real estate the right way, hop on the wait list for Creating Generational Freedom. The next cohort starts in September. And I think it's super important to know what you're doing, and education is the best way of mitigating risk.